By now, you're probably familiar with our HELOC strategy, using a HELOC to pay off your mortgage. Well, in this video, I'm gonna go ahead and react to Graham Stephan, who's also reacting to our strategy, and why some of his key points are incorrect. Hey, what's up everybody? This is Sam Kwok here, one of the Kwok brothers, and lately I've been getting a lot of questions and feedback about this, and that is Graham's video about why you shouldn't use a HELOC to pay off your mortgage. But there's a lot of things that he's outright incorrect or have misled you guys to believe about this strategy.
Wrong.
That is absolutely
wrong.
Proved over and over again.
Wrong.
He actually had.
Now, no disrespect to Graham, I appreciate and love his channel. In fact, I'm a subscriber myself, but in this particular video, there's some myth and not so true information that he shares. And of course, there are some details that he didn't really cover. So what I'm gonna do now is I'm gonna go and share my screen, hit play on the video, and provide my commentary for you guys.
Now first, when it comes to doing this, I think it's really important we address a comment I've received far too often that really needs to be talked about, and that is the concept of paying down your mortgage early with a HELOC. I've never really understood why anyone would do this or how this would even be a topic of discussion, but once I started digging deeper, I realized that this method is frequently published and emphasized by people who don't understand math, as well as banks who just have a financial interest in you spending more money with them, so they make it sound way better than it actually is.
Okay, so I'm gonna pause right there. First of all, this strategy has been around for about 25 years. That's actually been around quite long. So it's not a new fad that just came out last year or 2 years ago, and it originated from New Zealand and Australia. Now, in fact, in places like Australia and New Zealand, this strategy is a common strategy to pay off your mortgage. In fact, it's often published in Australian articles, and I'll post that right there. And I'm gonna highlight this in just a sec, some success stories of people who used our help and our strategy to pay off your mortgage.
Let's go over exactly what a HELOC is, how you can pay down your mortgage early with this, and why you should also never do this in like 99.999% of situations. So first, what is a HELOC? This just basically stands for a home equity line of credit. This is pretty much just using your home like a bank account where you borrow money against the value of your home, and then you only need to pay back what you actually end up using. This functions similar to a credit card where you only pay interest on the amount of money that you actually use. And with a HELOC, you typically only pay interest for a certain time frame, and then when that time frame is up, you enter what's called a repayment period, where you'll then pay principal and interest until your full balance is paid off in full. Full balance paid off in full. I guess that one.
Okay, so far he's correct about the definition of the HELOC, and this is where it starts to take a turn into the incorrect zone. I'm gonna start debunking some of the things that he says that are outright untrue or have been misled or reframed to be untrue, okay?
And in many situations, a home equity line of credit can be awesome. Like if you ever need cash for an investment but you don't want to refinance your entire mortgage, a home equity line of credit is actually really useful. And many people also use a home equity line of credit to fund a business or pay for a home remodel, but using it to pay down.
Real quick, I 100% agree with what he says there. You should be using a HELOC to buy investment properties, acquire businesses, acquire income producing asset. 100% agree with Graham, and this is something that we teach here in the Kwok Brothers as a consequence of paying off your mortgage using a HELOC. So let's continue and see what Graham has to say that is negative about HELOCs.
Mortgage, on the other hand, can get a little strange. So the concept of paying down your mortgage with a HELOC goes a little something like this, and by the way, this is super confusing, so just stay with me here, because to logical people like you and I, you probably won't get it, but let me at least try. Let's say that you have a $500,000 home, but then you have a $200,000 mortgage. This leaves you with $300,000 worth of equity that you could then borrow from. Then you open up a HELOC and you borrow $100,000 from that credit line. Then after that, you take that $100,000 that you borrowed and you pay down your mortgage with.
All right, so first sin, or first debunking here. In our videos, we suggested not to use the entire $100,000 limit that you have. So Graham is talking about how you have a $100,000 home equity line of credit limit. And in our videos, we suggest that you only use up to 30% in most cases. Now, the reason being is that, number one, because a home equity line of credit is a revolving line of credit, maxing it out can have a detrimental effect on your credit. So we usually suggests that you use only 30% at a time of the home equity line of credit. And if you run into an emergency where you do need to tap into the 70%, you have that access. So first of all, we don't use all $100,000. We use only a portion of it at a time. Okay, let's go and continue.
With it. Now you still own the $500,000 home, but now you have a $100,000 mortgage instead of $200,000, and then you have a $100,000 HELOC payment that you now have. Then you put your entire paycheck,
not a HELOC payment, but a HELOC balance, okay? Just a little quick correction there.
Paycheck into just paying down the HELOC payment as soon as possible, and then you borrow more money from the HELOC if you need it for other expenses. So basically the HELOC just becomes like a checking account for you to draw from while you're paying it down at the same time. Then once it's paid down, voila, you've saved money on your mortgage interest because you've made a sudden lump payment and paid it down much faster. Now, if you're anything like me, you're left scratching your head thinking, that makes absolutely no sense. Why would anyone do this? And how could someone do so many mental gymnastics to think this is ever a good idea? Because
okay, let me pause right there. So Graham is going off and saying this doesn't make any sense, this is complete baloney. Well, I'll tell you the honest truth. It took me a little bit of time to actually understand what's going on, and it wasn't because I had to learn something new. It was a lot of it because I had to unlearn some of the preconceived notions that I had about paying off your mortgage. So a lot of us already know that doing extra payments to the mortgage will help it to reduce the principal balance, also reduces the interest and the overall time spent on paying off your mortgage. That's a conventional truth, and I won't disagree against that, right? If you want to do an extra payment, go for it. I have a whole nother video about why doing extra payments to your mortgage is actually a lot more risky than the HELOC strategy. But for me, it didn't make sense because I had all these layers of past experience and past understanding about mortgage. So it doesn't make sense if you're going with the wrong frame of mind. Part of this is you have to sort of peel back and unlearn some of the things you already have and take on the mindset of a student and find humility knowing that, you know what, I'm gonna try to understand this strategy without putting any of my own preconceived notion or past experience about mortgages. So let's go and continue.
I'll tell you, this makes zero sense to me whatsoever. First of all, a HELOC is generally at a higher interest rate.
All right, so I knew he was gonna get started with this point because everyone starts with this argument. HELOCs have a higher interest rate. Okay, let me break this down for you guys. There are two types of HELOCs that you could shop for. HELOCs are known as non-QM loans, which is non-qualifying mortgages, which means that banks have less regulations and restriction as to what they can offer inside of a HELOC, unlike the mortgage. Now, if you go shop mortgages, a lot of the mortgages are gonna be very similar because it's heavily regulated by the government. Now, with a HELOC, there's less restrictions, which means that banks can have different features, different interest rates, different option to draw the money out of the HELOC. So I like to say that no HELOC is ever created equal. So when Graham says HELOCs have higher interest rate, well, Graham, which ones? There are banks that offer significantly low interest rate as well as high interest rate. Yes, there are out there that are significantly higher in interest. Now, one thing that Graham doesn't talk about is the concept of first lien position HELOC. Now, what this is basically instead of having a primary mortgage and then a junior lien HELOC, right, having two accounts, this means that you can completely replace your mortgage with a HELOC. Now, a lot of times, first lien HELOCs have way less interest rates than second lien HELOC because of the risk that the banks are carrying. Now, this is very important, and I have a whole nother video about first lien position versus second lien position HELOCs. With a first lien position HELOC, you can go out and find 2.99% to 5% interest on these HELOCs, which is very comparable to your standard traditional conventional mortgage. So to debunk another myth, not all HELOCs have higher interest rate, just as Graham is painting out here. So it's really important for us to understand that not all HELOCs are created equal. There are different types of HELOCs with different types of offerings. That also follows a different type of interest rate.
So secondly, HELOCs are generally what's called a variable interest rate loan, which means that the interest rate you pay will fluctuate over time.
Okay, so another myth that I had to debunk here is that not all HELOCs are variable interest rate. There are fixed rate interest rate options for HELOC as well, whether that's through rate locking or it's just the fixed rate from the get-go. So here it is again, Graham painting a broad stroke, false information about HELOCs. Not all HELOCs are variable interest rate. They won't just go up magically. There are ways to fixed rate the HELOC, and that's something I had to debunk right there and outright untrue.
And third, with a HELOC, you also have to pay transactional costs, including appraisal fees, transaction fees, processing fees, smashing the like button if you haven't done that already fees, title.
All right, so a couple of things. Now, when you get a mortgage, when you go refinance, which Graham will suggest later down the road, you're gonna pay appraisal fee too. So it's not like with a HELOC, it's exclusive where you have to pay an appraisal fee. You're gonna pay an appraisal fee no matter what if you get a HELOC or mortgage. So throwing the stick at the HELOC because of the appraisal fee, I think is a cheap move on Graham. And also, again, not all HELOCs are created equal. There are some HELOCs that don't have transactional fees, which we've done the research and we found out which banks don't have those. So it's unfair to lump all the HELOCs in general into one category, and I think this is a little bit of an unfair assessment of HELOC products. And I'm not a banker, I don't represent a mortgage, I don't make money by selling a HELOC. So there's no incentive for me to tell you this, other than the fact that I wanna help you guys pay off your mortgage. Okay, let's continue.
If you haven't done that already fees, title costs, the list goes on. This all needs to be factored into the overall cost of applying for this line of credit, or whether or not this money might just be better spent somewhere else, like actually just paying down your existing mortgage a little early. And fourth, one of the main reasons I would absolutely never do this is that the interest you pay on a home equity line of credit is often not a tax deduction if you use that to pay off any existing debt.
Now, when it comes to using a HELOC to pay off your mortgage, it is true that you can't use the interest as a tax write-off on the HELOC side. But that's only true if you use a second lien position HELOC. But on the first lien position HELOC side, you can write off the interest on the HELOC itself and completely replace your mortgage in doing so. But even if you do use a second lien position HELOC to pay off your primary mortgage, wouldn't it be better to save a couple $100,000 doing this strategy rather than paying the couple $100,000 just to get the tax write-off? I mean, it's kind of like my friend who bought a $45,000 truck, and I asked him, hey, why did you buy a truck? You live in the city. You don't need a truck, right? And he's like, yeah, I don't need the truck, but I want the $45,000 tax write-off. And I'm like, that's ludicrous. You could have just not paid the $45,000 and paid a little bit of taxes and used the rest of the money and invested in other things like real estate or stocks. Why did you do it? So even when it comes down to using a second lien position HELOC to pay off your primary mortgage, yes, you won't be able to write off the taxes on the HELOC, but the savings you'll get out of using this strategy far outweighs any taxable liabilities you have using the HELOC.
Here are the real ways to do it. The first is what's called a refinance. This is where you go.
Now, when it comes to refinancing, generally I am not a fan, even if you do refinance into a much lower rate. The reason being is that when you go and refinance into another 30-year fixed, you end up going back to what's called a front-loaded interest zone. What this basically means is that when you start a new mortgage or you refinance, vast majority of your monthly payment goes towards paying the interest. So, for example, your monthly payment is $1,000 a month. Vast majority of your interest, depending on the rate, goes to paying the interest. But regardless of the interest rate, how amortization typically works is that vast majority of the interest is accrued in the beginning stages of the mortgage. It's not linear as most people think, which means that you pay the interest as you go. With amortization in your mortgage, vast majority of your interest payment is paid upfront towards the beginning portion of your mortgage life cycle. That being said, how this strategy works is that we're paying off the principal balance as fast as possible so that what we owe on the interest also goes down in your mortgage. But we're simply using the HELOC to pay extra into the mortgage as well as our paycheck, which will be explained in a bit, and still access the funds when you need it.
So if you're out there and you realize that you can save money on your mortgage by just refinancing it to a lower interest rate, then do it. Just like always do it. This is probably one of the best ways to cut back.
No, don't always do it, right? You shouldn't make a blanket statement on every little situation that you might be going through. So I honestly don't like absolute statements. This is why you may hear me say, you could, you may, or right? You don't hear me say 100% of the time, all of you guys should get a HELOC, okay? I don't say that, right? Most of you, okay, this strategy is gonna be great, but not all of you. All right, let's continue.
Back on your expenses and save some money. That's basically, it's 100% guaranteed. Now, the second method to pay down a mortgage early is to make what's called bi-weekly payments. Now, the way your mortgage is calculated is by your total outstanding loan balance. So instead of making one payment per month, you can make half of that payment every other week.
So what's interesting is that this strategy will work, doing biweekly payments, but it's actually interesting. Graham doesn't get the strategy because if he understands this concept, he should understand our strategy too. He said it. Your interest on your mortgage is calculated by the outstanding balance on the mortgage. So if you're using our HELOC strategy, and I don't know why he doesn't get this yet, because he's a smart guy. I'm not saying he's dumb or anything. In the HELOC strategy, in the accelerated banking strategy, what you're doing is if you got a HELOC balance of, let's say, $10,000, okay, this is your HELOC. Let's say you put all of your income into the HELOC of, let's say, $5,000. Now, by doing so, now you have a balance of $5,000 in your HELOC. So the idea is you're supposed to leave that HELOC balance low at $5,000 as long as possible so that when the interest is calculated, it's calculated on the $5,000, not the $10,000 balance. So what Graham is suggesting here, which is the biweekly payment, again, it works, but not as much and efficient as the HELOC. It works because you're tackling the mortgage balance twice in a month, which you're further reducing the average daily balance on the mortgage. But on a HELOC, the best part of the HELOC is it's revolving. You can reuse and pay it back. The reason why we use our entire income into the HELOC is so that we can get this benefit of low balance on our HELOC, but we can still tap into the HELOC balance to pay for our expenses and take care of our diapers, groceries, you name it. Now, this is something I don't necessarily share in a free video, but one thing that you can do is have all of your expenses get taken care of by a credit card. Let's say credit card's down here. Now, if you didn't know, any purchases you do on a credit card, it's interest-free for 30 days. So what I like to do is I like to do all of my purchases, expenses, grocery shopping, diapers into a credit card. And then at the end of the 30-day period, I'll use my line of credit to completely wipe out the balance of the credit card. But in that 30-day period at a time, my HELOC balance was at $5,000, which means the banks have calculated my interest based on the $5,000 balance, not on the $10,000 balance. Does that make sense? Plus, my credit card, because it pays me points and cashback rewards, I got paid to do this strategy while my HELOC balance is super duper low. So your credit card is kind of acting as a middleman. It's holding your expenses for you until you can use your HELOC to wipe out the credit card balance to zero. So if Graham understands that biweekly payments work, I don't know why he doesn't understand this works as well, because you're essentially taking down the entire balance on the HELOC with your entire income, but still have the ability to reuse that for expenses. Okay, let's continue.
So the third way to pay down a mortgage early is just by making extra payments towards your loan.
All right, now if I get $1 for every time I hear about extra payments, I'd be rich. Now, I made an entire separate video on extra payments versus using a HELOC to pay off your mortgage, and I'll give you a little synopsis on what I talk about. Now, let's say you do the extra payments on your mortgage, right? Okay, I'm gonna draw a mortgage and you throw extra payments into it. Will this save money? Absolutely. It's gonna save you money, it's gonna save you time, and it's gonna save you interest. I'm not saying that this is a bad plan, but the problem is, let's say you need to draw money out for emergency reasons, or you have a phenomenal investment opportunity and you wanna use some of the money to get into those types of opportunities. Well, with doing extra payments to the mortgage, the only way to get that money back out is through refinancing, and we already talked about how evil refinancing is, so we're not gonna do that. But with the HELOC strategy, because the revolving nature, you can reuse and pay back, you can access that funds anytime you want. Now, you might be saying, Sam, this is why I have a savings account. Like, come on, I got 6 months of savings. But my argument against that is, why not take the 6 months of savings, throw it in the HELOC so that it further reduces the balance on the HELOC, saving you interest, and you can reuse that money whenever you want. So it's essentially the same thing as a savings account. The only difference is you actually save more interest on the HELOC. Because after all, how much interest are you actually earning through your savings account? Like 1 to 2% every year, right? So most savings account today, if you're lucky, you're gonna get 1 to 2% saving annual percentage yield. But if you throw it on a HELOC, it could be anywhere between 3 to 6%. So that same money that you have earning 1 to 2% interest now could be saving you 3 to 6% interest by parking your cash in home equity line of credit. And you can access that funds whenever you want in case of a medical emergency. Maybe you have an investment opportunity that comes along and you can make way more than the 3 to 6% savings. So this is why I'm not a big fan of just extra payments, because you're achieving the same thing anyways at the end of the day, but you get access to cash faster, and this acts as a protection vehicle just in case you run into an emergency. This is why I'm not a big fan of the extra payment, let alone we haven't talked about how the entire income is now saving you the interest on the HELOC. We talked about that on a few minutes ago, reducing the average daily balance using all of your income in the HELOC. So anyways, let's go and continue.
But if you ever get like an end of the year bonus or any lump sum check or any sort of tax return and you throw it all into the mortgage, that could cut down your mortgage time.
Or a HELOC, you can just throw it in the HELOC and so you can access it later on and also save you interest. That's an option, right?
And finally, the number one best way to pay off your mortgage early that everyone's been waiting for is just to pay off your mortgage early.
All right, so I'm gonna stop the video right there, which by the way, I'm gonna leave the video link down below in the video description. I want you guys to go see it for yourself and compare that to our strategy and our rebuttal and my commentary on Graham's video. Again, not everyone is gonna wanna use this strategy. This isn't for everybody. If you don't understand it, I encourage you and I invite you to take a look at the strategy, come and look at our calculator, read about it. I'm not the only one that preaches this strategy. There are many other individuals that teach this strategy. Just go check it out. And like I mentioned, there's Australia and New Zealand. There are places where this is fairly common to pay off your mortgage. So, and again, I'm not hating on Graham Stephan here. In fact, I agree with a lot of the things that he teaches about real estate, financial strategies. It's just this particular video and this particular strategy, we have to put some truth to the table. So if you guys enjoyed this video, if you guys thought that this video was helpful, go ahead and smash the like button and subscribe to our YouTube channel for more videos about personal finance, real estate investing, and paying down your mortgage. And if you have any questions, go and drop them down below. We'd love to have a conversation with you, and I'll see you guys in another video. Take care now.